Welcome, welcome. Welcome to Crashes and Taxes. I am your host for this podcast, Rebecca Walser. Very happy to have you guys joining me this week. Lots of developments, a lot of things to go over with you guys today. So I'm really excited about that. Just coming off of the recent FBI actions at President Trump's Mar-a-Lago address. And, as an attorney who believes in the Constitution, no matter what side of the aisle you're on, obviously this is a sad day for American politics. And I dropped something. I believe it's a sad day for the rule of law. So we've crossed a Rubicon, that's for sure. And it's a little bit scary, and we need to keep on trekking and figure out what's going on here. So I just, I don't care what side of the political aisle you're on. This is not stuff that we do in the United States of America, which is to raid former presidents. I wouldn't want that to happen to any other former president. So I can just be assured that there will be a resolution to this in the very, very, very near future, and we will get some clarity, and we will move on as a nation, because I certainly don't agree with having. We'll see what comes of it. So we don't know at this point. I do think a lot of things are going to start happening that we'll see, and we'll see what comes of it. So I'm not a fan of that happening to anybody on either side of the aisle. It has nothing to do with politics. It's just, we don't have to run our country that way. We don't have to, raid former presidents or former congressmen or former members of anything. We can get it taken care of without all of that. So let's move on. I really want to talk today about the Inflation Reduction Act that everyone has been talking about. Congress, the Senate obviously passed it. I'm going to go into specifics of this bill. They passed it down the split, 50-50. That means that the two, I would describe them as more conservative Democrats, which would be Joe Manchin out of West Virginia and Kristen Sinema out of Arizona, both signed on. And those were, of course, the two that they would have had to have gotten to agree with that exact situation before it would have actually been approved. So then once they got the 50 votes, 50-50 doesn't pass a bill, but it does, it can go to the vice president to break the tie. And that's exactly what Kamala Harris did on Sunday, August the 7th. She broke the tie. It passed the Senate and now heads to the House. I'm sure that the House, which has a much bigger Democratic majority than the Senate does, which they don't, the House will pass it. And I'm assuming the House will pass it as is. We'll see if they make any changes, and then it will be off to the desk of this administration. So what is this bill? What is happening? And I want to go through, I'm going to kind of walk you through some alternative tax concepts so that you can see what has laid the groundwork for this particular bill, because that's what has happened. We had a previous bill that actually did some things. I want to get you up to speed on that so you can understand where things started to change, because they did start to change in 2021 when this administration took office. And now you'll be able to see, okay, here's the changes that are now being implemented into this new bill. So let's go ahead and start our little presentation here. And specifically, I'm going to lay the groundwork for what is coming. And that is really the point of today's podcast. I'm going to skip through a couple of these slides because you guys don't need me to go through the S&P right now, but it really is interesting to see the inflection point and where we've come since the beginning of this year. And I want to go into some alternative assets. You can see that this is wrapping, so that's very interesting. Okay, here we go. So today we're going to talk about some precious metals, real estate versus REIT, private equity, peer-to-peer cryptocurrencies, but it's all in the sense of what have they already done with alternative assets that we can see laying the groundwork into this new bill that they've got. The first thing I want to talk about is that you need to understand there's two different income tax schemes. There's actually many, many more than two, but for the main retail consumer, U.S. taxpayer, which is not a corporation, corporate entity, which is not a business, you really have two main tax schemes. You're either in the ordinary income scheme or you're in the capital gain scheme. And those are really the two tax schemes. Now, inside of the ordinary income, there's a lot of things that qualify as ordinary income, pretty much W-2, 1099, any of those kinds of things. And then you have capital gains. Now, when people think of capital gains, they pretty much think of traditional capital gains. So that would be a short-term capital gain or short-term capital loss, which would be a loss on your investment that occurred or a gain on your investment that occurred within less than 12 months. We call them short term. Once we pass the 12-month threshold or holding period of at least 12 months, then we're getting into the long-term capital gains and the long-term capital losses. And you know that those rates from the Tax Reform Act, basically that Trump promulgated in 2017, that went into effect in 18, basically reduced the capital gains taxes to three brackets: 0, 15%, and 20%. Then we have what we call unrecaptured gains. So that's section 1245 and section 1250. That deals with real estate. If you sell real estate and you depreciated some of your real estate because of you're able to depreciate under your property under section, all kinds of different sections of the IRC. If you did that, then when you go to sell, part of that gain could be ordinary, classified through recapturing of depreciation as ordinary income. And just think about it. If you have a property that you're renting out and you're renting it for $1,000 a month of income, interest, rental income, and let's say that you were depreciating it at, I don't know. I'm just thinking off the top of my head. Let's say we're depreciating it at $1,200 a year. So that's $100 a month of depreciation. So my $1,000 of rental income is going to not be fully taxable because $100 is going to come off of that income sheltered through depreciation. So you can see that I'm sheltering ordinary income from ordinary income tax as I depreciate my asset down. When I go to sell, if I've held over 12 months, then it becomes a long-term capital gain, except to the extent that part of my gain is due to depreciation. We recapture the depreciation. We pay up to a maximum of 25% on recaptured depreciation, depending on your tax rate. So if your tax rate is 22%, you would pay 22% on the depreciation recapture. And then everything beyond the depreciation recapture under section 1245 is going to be classified as as long-term capital gain, as long as the holding period was greater than 12 months. So just keep in mind when you go to sell real estate that there are some additional rules if you have depreciated down and you have a gain. And then the last thing that we have that's getting cut off is collectibles. Collectibles is a long-term capital gain, but it is subject to a maximum tax rate of 28%, but collectibles 28% can go up if you are subject to AMT, alternative minimum tax, or also if you have the QBI deduction, the qualified business income, section 199A deduction. Those two things getting factored into somebody who is taking those could then make their collectibles tax higher than 28%, but normally collectibles is going to be 28%. So let's move forward here. You can't probably tell or see this, but this is the 2022 tax bracket. And what I wanted to point out to you is that it's not until you really get to above $370,000. So you can see here that the 32% bracket for married filing jointly starts at $340,100. But we have a standard deduction of $25,900. That's coming straight off the top, whether you have any deductions or not, you're getting $25,900. So if we add $25,900 to this $340,100, you can see that it takes us almost about $370,000 just under for us to even get into the 32% tax bracket. So what Trump's tax reform did was it really widened the brackets. It lowered each bracket down by 2 percentage points. So the top bracket of 39 went down to 37, et cetera, et cetera. And it really widen the bracket so that it took a lot more income for you to get into a top bracket. That's important as we go through these changes that we're going to be talking about with this new law that's getting passed. This is the capital gains brackets. You can see from married filing jointly, you are, if you have zero income, you have zero capital gains tax, okay? But once you're getting to 83,350, you're starting to get into the 15%. So you have to have taxable income of above 83,350. You're at the 15% cap gain bracket, and then you stay in the 15% capital gains bracket until married filing jointly has at least $517,200 of taxable income. Now, one thing that people don't do is they don't count the capital gain as part of the taxable income. The capital gain does count as part of the taxable income. Therefore, if you sell a piece of property that has a $500,000 gain, and you can't shield that from Section 121, which allows you to sell your primary residence every 2 years, basically, and write off $500,000 of gain if you're married filing jointly. Basically, if you are above $500,000 of total income, including your gain, about 517, you're going to be in the 20% capital gains bracket. So if you've sold a big asset and you've had a large gain, you're going to be in the 20% bracket as long as your total income is over 517. So that's how the head of household works. You can see the single and the married filing jointly levels here as well. I want to go through collectibles and specifically precious metals and ETFs. There's a lot of people that have really talked to me about gold recently and leveraging gold. And I think gold is a great leverage, but you have to understand that depending on how you're holding it, you might be subject to collectible capital gains taxes, which again, subject to a maximum of 28% versus standard 20% would be the top tax on a capital gain under a normal long-term capital gain traditional scheme. So the thing is that if you are holding art, rugs, metals, precious metals like bullion, coins, gold, silver, palladium, all of these things, you probably are going to be under the collectibles section because you're physically owning metals. Now, this extension of ownership goes through ETFs as well. So if you invest in an ETF that's in a mining company, a gold mining stock company, and you buy an ETF of that, you are not going to be inside of the collectible scheme because you do not own the metals. So if you're investing in mining or gold futures or any kind of metal futures, that's traditional long-term capital gains. However, if you have physical ownership, so there are a lot of ETFs that are actually trusts and you own a percentage of the trust through your ownership of the ETF, and the trust only holds precious metal, actually only holds the asset class that you're buying. That is considered ownership of the metal. It's paper ownership, but it's ownership nonetheless. And that then subjects you to the collectible capital gains tax. It is up to 28% maximum, but it is your income tax bracket. So let's say that you're in a 22% income tax bracket and you have sold collectibles and you do have a capital gain. That capital gain is not 28%. It's going to be at 22% because it is at your top ordinary income tax rate or 28%, whichever applies. So if your capital gains bracket is in the third, if your ordinary income tax rate is 32%, that bracket that was really wide that we really focused on, but you have a collectible long-term capital gain, it's not going to be at 32%. It would be at the maximum of 28% unless AMT, alternative minimum tax, and QBI 199A apply. This is why you need a tax expert to decide what is your actual ultimate collectible tax on the long-term gains. But I just want you to be aware that if you're physically owning, that is a condition. You guys can't see it, but I do talk about IRAs here, and I caution you to make sure that you understand what you're doing inside of an IRA through Section 408M3, which is the IRC Internal Revenue Code that specifies how to own precious metals inside of an IRA. Unless it meets the exceptions that are listed in Section 408M3 of the Internal Revenue Code, then you will need to be in a self-directed IRA in order to hold that metal. If you buy something through your IRA that is not an exception under 408M3 as defined, then you could not only have considered the IRS or the government will consider you to have taken a distribution from your IRA, but if you're under 59 and a half, you can also have a 10% penalty. So you need to make sure when you're dealing with metals and all kinds of alternative asset classes with an IRA that you need to either consult an expert or you need to go to probably self-directed so that you don't get in trouble because there are parameters and requirements. So that's to let everybody know who's really interested right now in some commodity hedges that you can do it, but you need to do it smartly and you need to make sure you understand the favorable tax situation. I want to quickly talk just very quickly about direct real estate ownership versus REITs. We already have gone through the example of a capital gain and that you have more capital gain that's part of it is due to depreciation that you formerly took against ordinary taxable rental income. And so now you recapture, you pay that tax, ordinary income tax back on what you basically depreciated off, and then the balance of it is a capital gain. But REITs can operate a little bit differently depending on the REIT that you're discussing. So you need to look at the tax parameters. You need to have a discussion with the promoter of the REIT around the tax parameters. For example, a highly favorable taxable REIT basically will allow part of the yield on an annual basis to come back as a return of principal. So it's a return of principal shield. In other words, if I have $5,000, I'm just making up a number here. If I have $5,000 of yield or income from a REIT, but yet 90% of that is considered by the IRS to be a return of principal, then basically I have not paid tax on 90% of that distribution. I'm only paying tax on the 10% that is recognized as taxable outside and above a return of my principal. So that's the first positive benefit if you have a REIT that is able to operate as a return of principal and shield a lot of the yield from the income. Then the great thing is that even though it's treated as a return of principal so that most of it's sheltered on the cash flow and only some of it's taxable, when you go to sell, because you basically recaptured your depreciation along the way, there's no depreciation recapture and all of the gain is considered, as long as it's over a 12-month holding period, long-term capital gains subject to long-term capital gains rates. So what I'm trying to tell you in a nutshell is if you get with the right properly structured REIT, you can actually have the same cash flow that a traditional direct ownership of a property could have. But instead of you depreciating and shielding some income and having to report all of the rest of it, a lot of these REITs are structuring yield as a return of principal. Yet when you go to sell out and you sell with appreciation, all of your gain is converted into long-term capital gain. So a lot of your income is shielded completely from income, and then yet your gain still remains long-term capital gain favored tax status. So real estate inside of REITs can be a viable tax strategy. Now, here's where we're getting into what's really happening with the new law. And we started to see this last year. And this is why this is really important and right on point for this week's podcast. And I'm talking now about the changes that were made in carried interest, specifically private equity under Section 1061 of the IRC. Now, you might be saying, oh my gosh, Rebecca, what are you talking about? So I do have a little graph here to share with you guys to let you kind of see what I'm talking about. So private equity is really an LP, a limited partnership. So you can see right here, we've got this generic private equity fund. We have 3 limited partners, what we call LPs. We have 1 GP, general partner, and the GP has hired investment professionals. So under current code, basically when a general partner invests or is the general partner of a private equity fund, they get paid through something called carried interest. So the investment professionals are getting management fees, and the general partner could be getting management fees because they're obviously managing, but they also are being paid carried interest. Carried interest basically is the profits distributed to the general partner over the length of the partnership, and they really are taxed at a 15% favorable tax rate. So this has been a really big issue, and a lot of people have wanted this to change. They call this a tax loophole for wealthy general partners that have these kinds of investments. And I don't know that they're wrong about that. I do think that there is, there's the capitalist in me that says, hey, these people took a major risk, made a major investment, it worked out, they got paid. We need to encourage through tax policy investment. We need to encourage research and development. So this was where this concept came from. you can see over here, the limited partners aren't getting carried interest. They're getting something called capital interest, which is different than a profits interest. It basically is just literally a capital interest in the value of the partnership. We go back to this and we talk about carried interest and what they did in section 1061. And they basically increased the holding period already prior to this act. They already increased the holding period to 36 months in order for the carried interest to maintain. But people were still very upset. And you can see that we just got final regulations on carried interest of the law, the rules they just changed just last year in 2021, because they made some changes with the tax reform bill. So we got final regulations last year, and now it's back up and back into this bill, or at least it was. And that's why I'm bringing it up to you. So before I explain to you what's going on with carried interest, I want to show you exactly what has happened that basically brought out that situation. So I need to come back here, and I don't know if this thing isn't actually showing my slideshow as I had planned. So let me just talk you through it. So I remember I said to you that we've already had a change, and so you're not going to be able to see it right here, but it was the American Rescue Plan that was passed in March of last year, 2021. And in March of 2021, I don't know if you guys remember, but there was this huge uprising when Biden started talking about the tax changes that he wanted to make. And he started saying that he was going to make everybody on in America that wrote a check or paid somebody outside of the annual gifting exclusion, which right now is $16,000 per year per person that you can double if you're married. Outside of the $16,000 annual gift exclusion, which means you don't have to report a gift to a person up to $16,000 a year, they wanted us to be reporting every time we pay anybody $600. So if it wasn't a gift, if I paid $600 to an attorney, they wanted me to report that with the attorney's, basically EIN, employee ID number. Everybody was in an uproar about it. It didn't go through. They knocked it out. They said, no way, we're not going to have all this compliance. It's not going to happen. However, he took that concept, and in the American Rescue Plan, he put in a requirement that all payment entity settlers, or so basically all of your Venmos, your Cash Apps, your PayPals, all of these third parties that transfer funds between individuals, if the transfer amount is $600 in aggregate, doesn't matter how many transactions you have, whether it's 1 or 5 or 200 or 2,000, anything that aggregates $600 or more, they are going to send you a 1099-K on an annual basis, and they will send that by your Social Security number. So they'll start collecting your Social Security number. If you haven't already noticed, they're going to start requesting your information, your Social Security number, because that is a report they're going to send to you on a 1099-K, and they're going to send that to the IRS. So you're probably saying, okay, what does this have to do with the carried interest and what we're talking about? So the first thing was that I remember I told you that we needed both senators, Joe Manchin and Kristen Sinema, to agree to this plan. Joe Manchin was seriously adamant about getting the carried interest eliminated. Sinema came back in, and basically Sinema wanted the carried interest. So the results are that basically stock buybacks tax is in and the carried interest is out. And that is what's heading now to the House as I'm doing this podcast in the interim. So the stock buybacks are going to be charged a 1% tax that will go to the federal government, but the carried interest of 15% stays with its updated required holding period of 3 years as changed, and the rules. That alone is an entire podcast on how carried interest works. I just don't know that it's really helpful unless you're a hedge fund or a private equity investor. So we took this concept in the American Rescue Plan of these third-party exchanges reporting all of this information. So all of these payment settlement entities like the Venmos, like the Cash Apps, those are going to now start doing this reporting that the government really wanted individuals to do, that freaked out and had a major backlash, and they said, okay, never mind. So that brings me to what else was in that bill, in that American Rescue Plan, March of 2021. And this was a formalized exploratory process to arrange and consider the launch of a U.S. CBDC, central bank digital currency. In other words, a digital token that is backed by the government. This is one area of a hill to die on that we all as Americans that have any kind of freedom should stand against, because while it might be more convenient, it will also be the end of all privacy of any kind. The Federal Reserve will immediately know everything you're paid from every source derived. And of course, they will know everywhere where you spend money at every source derived. And the point of that is that we have a right, as interpreted by the United States Constitution, to privacy under the First Amendment of the Bill of Rights. And so when you have currency that is directly tied into the government, while the Federal Reserve is a private corporation, it is quasi-governmental in the sense that it works directly with the federal government to regulate our money supply. And this would be an ultimate reporting of everything that you're doing and that is going on. So this exploratory process was defined and authorized under the American Rescue Plan, the same bill where they started requiring the third-party PSCs, payment settlement entities, to report the $600 per transaction. This is important because this is laying the framework for what they're doing now, which is related to cryptocurrencies. And so with cryptocurrencies, Biden signed an executive order on March the 9th of this year, March 9, 2022. And that executive order directs all federal agencies to promulgate proposed rules for regulating cryptocurrencies. So you've got Department of Homeland Security's reviewing how would cryptocurrencies be interacted with or used in the Department of Homeland Security, and how would we write rules to promulgate how we think the law should be executed in that area. For example, if you saw illegal migration through Mexican cartels coming through the Texas and Arizona border, you might say, hey, they're leveraging cryptocurrency to pay these cartels to transport them across the border. We need to go regulate the crypto and we'll get the source of funds. So the whole executive order was directing all federal departments to promulgate the rules they think they need in order to effectuate their jobs while cryptocurrency and distributed blockchain technology is a reality. And so, putting all of these pieces together, what we are finding is that this administration is not able to regulate directly. They then circumvent by regulating third parties. And this is exactly what they're looking to do. It was successful and has been successful with the PSEs. And now they're looking to do this with the third party intermediaries on the blockchain. So what am I talking about? I'm talking about the Coinbase and the CoinFlip and the Kraken and these third party intermediaries where you go to them and give them US dollars, and in exchange trade the dollar for either a crypto like a Bitcoin, an Ethereum, or something else, or a stable coin, USDC, US dollar stable coin. Maybe who knows what transaction you're doing, doesn't matter. I can tell you that the regulations are looking to force the third party intermediaries that are taking your dollars and giving you back crypto, and then you're coming back in with crypto and redoing dollars. That intermediary, they're expecting to start to force to do mandatory reporting, just as they've done with Venmo, Cash App, and the PSEs successfully beginning in 2021. That all brings me to this new law, and specifically the impact on taxes of this new law, because you can, as you can see my screen here, you can tell that my whole point is how do we not have the taxes just go outrageous? So the first thing I want you to understand is that this is mostly, I would say, outside there. This is really a three-part bill and an eventual law. One part is all about green energy and green funding and green subsidiaries for green technology. It's all about the green, green, green energy. It is a reduced version of the Build Back Better. Build Back Better was 100% really a climate-based bill. So this is really a climate bill. The reason it's called infrastructure reduction, I have no idea. It is an oxymoron. It's a misnomer because it is the authorization of about $730 billion in new spending. And that new spending is not going to not be inflationary. What they say is that all of the taxes are going to be falling. This is the people that are writing the bill and getting it passed. So this is what they say to win the argument. They're basically saying that these taxes are at the corporate level. For example, the 1% stock buyback is a corporate tax, for example. But the other thing that they're wanting to do is they're wanting to charge 16.4 cents tax per barrel of imported crude. Now, the Joint Committee of Taxation, which is a bipartisan committee in Congress, analyzes and assesses these tax bills for their tax impact. And the Joint Committee on Taxation, which again is bipartisan, they themselves said that in 2023, there will be on people that earn less than 200,000, so 200,000 and under, there will be an additional increase of taxes of over $16.4 billion in 2023 alone. For those making over 400,000, the taxes are going up $14+ billion. Most people that will fill this tax will be under the $400,000 range, and really from 75,000 to 200,000. That is the brunt of the taxes. Now, what's happening when these politicians are telling you that this is not taxing individuals? It's not taxing individuals, but it's taxing the corporations that do not pay the taxes because they pass the cost of doing business always onto the end consumer or the end user, which is us. So that is why the Joint Committee on Taxation calculated how will it directly impact Americans that are making $200,000 or less. And they told us it's another $16 billion in taxes next year on 200,000 and under. The other thing that this bill does is it makes the IRS bigger than the Pentagon, than the FBI, and these are departments combined. There's going to be 87,000 new IRS agents hired through this bill. Now, they talk about that it's just going to be a corporate tax, but yet 87,000 more agents. I checked the stats, and as of 2020, as of September 15th, 2020, the United States had 642 billion, we had 642 billionaires. The top 4 states for our billionaires, we had 189 in California, 114 in New York, 60 in Florida, and 58 in Texas. So those are the top 4 billionaire states: California, New York, Florida, and Texas, in that order. There's a total of 642 billionaires in this country. 87,000 agents are not necessary for enforcing the taxation on billionaires. If we look at millionaires, we have about a little over 11.5 million millionaires. So these agents are not coming after the corporations. They're coming after you and me and the people that are regular citizens making regular income. And you can be a business owner and you can be making 400,000. They are looking at how can we ensure compliance. They got a taste of auto reporting at the PSE level. Now we're going for auto reporting at the exchange level once the rules become promulgated for crypto, and the rules will change, which is why we've always said crypto is speculative at best, not because we don't believe in blockchain, because we do. And certainly the technology for blockchain that is going to you can't even imagine the technology that is coming. It's so out unbelievable. But that is not going to be the reason that 87,000 people are getting hired and making this a department of federal government that's larger than the Pentagon, that's larger than the FBI. This is massive, and it is going after tax compliance for every single person down to the person that has very little. There's no other explanation. You can't hire 87,000 people and say, we're just going after millionaires, billionaires, and corporations. No, they're coming after all of us. And the $600 limit should have been a clue that that is what is going on. So at the end of the day, what are we left with here? We're left with the fact that we know the baby boomers are now within their 6 final years of massive migration onto Social Security and Medicare. By 2028, in just 6 years, we'll have 95+% of the baby boomers fully retired on Social Security and Medicare. This is the first and largest demographic shift from workers to recipients in the history of our country. We can look at Germany and Japan as examples. They're about 10 years in advance of us. And I can tell you that you've heard me talk about Japan before, 260% GDP, debt to GDP ratio, horrible. And Germany is now absolutely under the collapse of the energy situation with Russia. Their economy is now not a net exporter, which is the first time in 30 years they've not been a net exporter, but they've got some massive, massive problems. And so we can see that as your population goes into sandwich generation time. And what do I mean by sandwich generation? What I mean is there's so many, there's still some greatest generation baby, and then there's baby boomers on the public system, which they deserve to be on that. No one's questioning that. Then you have the sandwichers that are working still. So that would be your Gen X and your millennials, and the beginning of Gen Z, or actually we're quite well into Gen Z now, that are working. So those are the 3 generations that are working to support those that are already retired. Now, the problem is we really are far into Gen Z already working. So as we start to see people move in mass onto Social Security and Medicare, unless we have the same commensurate Gen Z numbers coming in to still be working, we have a lopsided situation that's going to be happening these next 6 years. And then keep in mind the other problem, the baby boomers that are retiring, these people have been working for 30 years likely, and they're probably at the top of their income. When you try to replace those people with now the Gen Z gig economy, totally different way of working. These people necessarily don't want to have a 9-to-5 W-2 job. Maybe they want to, do something on YouTube, and then they want to drive an Uber car for half the time. I mean, the Gen Z is the most entrepreneurial group and generation that we've seen in probably, I want to say at least 2 decades, 2 generations. So we are seeing a lot of new working relationships, more entrepreneurial, more on my own, not W-2'd employees. And that brings me to my last point, which was the jobs report that was released for the month of July. And obviously we were expecting 260,000 jobs and we got 580,000. And so it was a big plus to the upside, and it was quite surprising. But I want to issue a word of caution, because when you dive into that report, what you'll notice is a lot of those jobs that are being picked up are second and third jobs for people that aren't able to meet their basics of food and gas and rent, or mortgage, on just their regular job. So we did get a lot of second and third jobbers that came into that report that made the top line number look really brilliant, until you drive down into the actual data and metrics and you see that, wow, this really is an indication that a lot of people aren't able to make enough on their first and primary job, that they're going back out and picking up a second and a third. It's really a lot more indicative of a non-healthy economy, because people aren't able to make enough on a first job. That's not a good sign. So we have to always be careful with these economic numbers that come out. I know that the administration doesn't even want to call a recession now. It was interesting because we thought we were going to get a recessionary period while Trump was in office at one point, and all of the people, all of the prognosticators came out and said, multiple times, a recession is 2 consecutive declining quarters of GDP, or gross domestic product growth, and that would be technically a recession. And all of them said this thinking that we were going to get those numbers with Trump in that particular time. It didn't happen that particular time. But it's interesting to see the week that the numbers came out for second quarter GDP, that this administration was trying to rework the definition of a recession and saying that it doesn't just equal 2 quarters of negative GDP growth. It also equals employment and all of these other things, which I don't disagree. I don't think that straight up just 2 consecutive quarters could be solely a recession, although that has been the technical definition. I do believe that there can be things that happen that are related to war, related to other things that maybe aren't necessarily the economy. But it's just interesting to see how the different stances of the media, depending on who is the actual president. So we don't have a great economy. What I'm really more concerned about, which I have talked to you guys about, and I really wanted to do more of just a technical, podcast, giving you some tax information, giving you some most of these recent bill information. But I just wanted to tell you to prepare, because what I'm really more concerned about, as you guys all know, and thank you all so much for reaching out after my last podcast and letting me know all of your good well wishes. I want to just encourage you and let you know that I'm good. My practice is good, but this is a transitory period. 2022 will go down in the history books as the largest financial correction in the history of the world. That is my personal opinion based on everything I've seen. So I would just tell you to buckle up. Between now and the end of this year, you're going to see things that you never even imagined that you would see in your lifetime or in 1,000 lifetimes. That is going to be how much information comes to us in these next few months. The world is on fire. If you're not hearing it from mainstream media, it's because we're trying to keep calm for as long as possible. But the United States will not escape this coming storm. There is no doubt about it. You need to prepare yourself for what is coming and what is inevitable. I think that if you have gotten yourself in a protective, defensive mode, a lot of people ask me, Rebecca, what's the equity play right now? And I'm just going to tell you, good luck with that, because when you see a systemic global situation like we are in right now, which is the end of fiat debt-based currency, that is what we are at. We are at the end of fiat debt-based currencies. We really got there. I've told you guys before, we really started to get there at the end of 2019. We had to recapitalize the banks in the United States to trillions of dollars, which wasn't even reported until it's a big story. We were really at the end of 2019. We were required to recapitalize a lot of our banks in the United States. A lot of people don't know this happened. It did happen. And then coronavirus happened, and we were able to buy ourselves another 2 years because of all the stimulus that everybody accepted as normal, because we were in the middle of a global pandemic. So the United States was able to print 10 trillion. And the rest of the world was able to print 20 trillion. And that got us through to now the point that we are at. Now, as you look across the world and you look at China and you look at what's happening in all of these countries, and you see not only the revolt of the citizens because they're promulgating a lot of the ESG requirements, which are limiting fertilizer and nitrogen. So you've got like a third of the farms in, for example, Holland, that are going to be shut down. This is now coming to Canada. It's coming everywhere. This Build Back Better is part of that here in the United States. This is our version. So all of the world is passing massive ESG rules to affect farmers and affect businesses and affect all kinds of communities. Of course, the next thing they want to do here in the United States is they want to start tracking your carbon footprint at your individual level. And this is something that is in active talks right now with Experian, Equifax, and TransUnion of the amount of data that can be captured and promulgated on your credit report. So it will morph into more of a social credit score, something similar to the Japanese model. This is already happening in Australia. It is happening the world over. America is not exempt. So I tell you all of these things to let you see for yourself that while they say these are corporate taxes only, they are hiring an army larger than the Pentagon, larger than the FBI, that will basically, and the IRS outside of the military buys the most bullets of any federal agency. You need to look, there's congressmen and there's senators that are introducing legislation as we speak to prevent the IRS from buying ammunition, asking the question, why is the IRS buying ammunition? There is a criminal division of the IRS. So there is a level of tax fraud that will get you a criminal investigation, and that they do show up with guns. I mean, it's absolutely a fact. should be more rare because tax is more of a civil matter and not a criminal matter, but there are cases that cross into the criminal code. And so that is the reason for the buying of these kinds of things. But at the same time, that should be more rare and not as much as they're doing. So we are going through a global financial change. And what we're doing right now in the United States is adding more IRS agents to make this law work, even though supposedly it's only a corporate tax. That doesn't really make a lot of sense. So just keep your ears open for what is coming out and what's starting to be promulgated out there for you to understand that this is a global situation. Look out into the world, find out what I'm talking about. If you don't know what I'm talking about, if you're not seeing on any of the news sources, go search, ask yourself, end of global debt currency globally. Things will start to come to you. You'll start to find this information. I wish I could give you all of the sources I had, but literally this is all you do with your life, because this is all I do with my life, is preparing for what's going on, preparing my client base, and then sharing as much as I can publicly with you guys. So I thank you again for all your well wishes from the last meeting. You know, it's been a tough road, but we're on it and we're getting close to this end. So I'm prepared. I know you can prepare as well. And together we can be a really great buffer for what a lot of people are going to go through that really don't have any clue this is coming. Because again, the media keeps everything as smooth and as calm as possible by design. And that's part of why Americans don't really understand what's really happening globally. So I hope you have a great week. Until next week, everybody, enjoy life, because it is still a beautiful thing to wake up every day and see the sun and watch it set and enjoy, smell the roses. That's what my husband always tells me, is you need to stop, Rebecca, and smell the roses. So this is the time to do it, because things are going to start to get a little bit crazy here these next few months. And we'll be here to help guide you as much as we can. Take care, everybody.